Alright team, today we're diving into a bold call from Dan Ives, Wedbush's global head of tech research, who just went on CNBC's Closing Bell and said, Tesla will own 80% of Autonomy. That's right, the lion's share of the Robotaxi future. In this video I'm gonna play you the clip, then I'll break it down in plain English. What he means, what's realistic and what the data needs to show before Wall Street fully rewrites Tesla's story. Stick around, because after my reaction I'm sharing my in-depth analysis of the 3 best autonomous driving stocks to buy now, based on everything we're seeing in adoption, regulation, and monetization. If you care about where the physical AI profits actually land, cars that drive themselves, software that prints high-margin revenue, this is the one you don't want to miss. Before we roll the interview, do me a quick favor, tap that like button, let's push this to 1,000 likes, share this with a friend who's watching Tesla, and drop your take in the comments. And if you're new here, hit subscribe so you don't miss the next big investing breakdown. Alright, let's hear Dan Ives, and then I'll give you my full reaction and the 2 stocks I'm buying for the autonomy wave.
Dan, you are getting even more bullish on Tesla. Tell us why.
I mean, look, I think this is now going to be the start of probably the most important chapter of growth ever for Tesla. In terms of autonomous, I believe we're going to see 30 cities, potentially over the next 3 to 6 months. And that's going to be the start. Because, Courtney, my view is that they will own 80% of the autonomous market, and that is not being factored into the stock. I mean, that's why I think this is $2 trillion for starters. Ultimately, will be a $3 trillion market cap. This continues to be, in my opinion, the most undervalued true AI play in terms of physical AI play out there.
But how long is it going to take them to get to that type of market share in autonomous?
Oh, I think as we go into later this year, and I think especially once we go through the shareholder meeting, when Musk gets pay package and ultimately Tesla gets approved for the XAI investment, I think investors are going to start to realize when this gets rolled out to another 8 to 10 cities over the next few months, and you start to see the scale of ultimately cyber cabs, I think that's where the bell goes off. I think investors right now, there's still skepticism because of the core business, which is actually stabilizing. We'll see that next week. But I think this is all about autonomous and robotics. I think this, along with NVIDIA, the 2 best physical AI plays in the market. And Musk now is back to wartime CEO. And that's what you need in terms of this AI arms race.
Wow. And so your target is going from 500 to 600. And I think the average analyst estimate is somewhere around $342. And you think that is all because of autonomous?
Well, yeah, because I think when you look out, when you think of golden goose for AI, it's autonomous and ultimately it's robotics. And that's going to be Optimus. And I think Tesla right now is on the verge of what I think is going to be a period of hypergrowth. And I think that's something that's not being factored in, is a lot of investors just continue to paint it with the same brush. And all the work we're doing is showing that this is an acceleration that's about to happen. That's why we raised price target, continues to be one of our top picks in this 4th industrial revolution.
Do you think that there's still some political backlash with those that didn't agree with Elon Musk or don't agree with Elon Musk and his association with the Trump administration, whether they're enemies, friends, frenemies? I don't know where they are right now, but how does that play out into demand for the vehicles themselves?
Yeah, I think you almost have to separate. I think, look, in Europe, there's clearly still brand damage, and we see that in terms of the numbers, but I think some of that is going to fade, over time, as well as in the U.S. Look, there still could be, like we said, 5-7% permanent brand damage, but I think the broader view here is that they're really going to own what I view as the autonomous world, the autonomous market. And you talk about with Trump and the BFF to the enemy and back now, I think it's all about regulatory. I think Trump administration is going to accelerate the federal roadmap in terms of what's going to be bullish for autonomous. And that's going to be, very important in terms of laying the groundwork for what I believe is going to be acceleration of this autonomous strategy. And I think that is how Tesla is going to be viewed. This is not just for Tesla, but for Musk, most important chapter of growth in its history.
Okay, let's start with the heart of Ives's argument. He basically says we're at the beginning of Tesla's most important growth chapter ever, driven not by selling more cars, but by autonomy and robotics. In his view, Tesla rolls out autonomous capabilities to roughly 30 cities over the next 3 to 6 months. From there, he thinks they could ultimately own 80% of the autonomous market. That, he argues, isn't priced into the stock. He calls Tesla one of the 2 best physical AI plays, alongside NVIDIA, raises his target from $500 to $600 and even sketches a path to a $2, $3 trillion market cap over time. Now, unpacking that, when he says physical AI, he's contrasting software-only AI, think cloud models and apps, with AI that controls stuff in the physical world, cars that drive themselves, robots that move and manipulate objects. If you buy his framing, the economic prize isn't just selling vehicles, it's layering high-margin software and services, autonomy, ride-hailing, potentially robotics, on top of a global hardware footprint. That's why he calls Autonomy the golden goose of AI. It turns a cyclical car company into a platform with recurring software-like revenue and operating leverage. He also points to two catalysts. One, a shareholder meeting he expects will approve Musk's pay package and AI investment, and two, a staged rollout into another 8-10 cities in the next few months, plus up to approximately 30 cities within 3-6 months. He believes those steps flip investor psychology from skepticism to acceptance as cybercabs, his phrase for robotaxis, begin to scale. He also notes the core business looks like it's stabilizing, his way of saying the foundation is firm enough to support the next leg. Here's how I view each piece. The 30-city rollout claim, this is the boldest call. Technically, expanding to dozens of cities quickly implies Tesla can replicate autonomy across diverse road rules, weather, and urban layouts without major retraining pauses. Operationally, it means standing up local operations, insurance frameworks, safety protocols, and monitoring, city by city. Regulators will vary. Even if you're extremely bullish on the tech curve, the real-world friction, permits, local liability nuances, safety reporting, creates drag. My take. A multi-city pilot footprint is possible, but functional scale, consumers reliably hailing and paying for autonomous rides without safety drivers, is the number that matters. Watch for paid rides, hours of driverless operation, and incident rates disclosed by jurisdiction, not just "we launched in City X." The 80% autonomous share claim market share that high suggests Tesla's data advantage, vertical integration, hardware plus software plus fleet, and brand convert into a dominant network effect. It could happen in the early innings if incumbents move slowly, but be careful. Autonomy is not a winner-take-all overnight. Cities may prefer multiple providers. Some OEMs and local operators will forge alliances. LiDAR-heavy alternatives will coexist in certain markets. My take, leadership is achievable. 80% sustained share is a stretch until the regulatory and competitive landscape is clearer. Watch for city MOUs, exclusive operating zones, if any, and third-party fleet partnerships. Those are leading indicators of durable share. Valuation, $600 target, and a $2 3T path. Ives is saying the market values Tesla mostly as a car company, and he wants investors to model autonomy robotics as a second business with software-like margins. On paper, that's reasonable. A robotaxi platform with high utilization and a take rate on each ride can be extremely profitable. But every line in that model, adoption, utilization, pricing, costs, regulation, has big error bars. My take, build scenarios. In a base case, autonomy pilots convert to meaningful paid usage in a handful of cities, then stack. In a bull case, regulatory tailwinds plus strong safety data accelerate multi-region adoption and yield software-like margins. In a bear case, progress happens but slower than equity markets tolerate, keeping multiples range-bound. Watch for actual revenue recognition tied to autonomy, not just deferred or pilot, disclosure on take rates, and city-level economics. Wartime CEO and the AI arms race Ives says Musk is back in wartime mode, the idea being tight focus, aggressive execution, and rapid iteration. Culturally, that can compress timelines, but it also increases volatility. Wartime works if the feedback loop between real-world data, model updates, and on-the-ground operations is tight, and if regulatory relationships remain constructive. Watch for cadence of software updates that demonstrably improve autonomy, KPIs, interventions per mile, disengagements, incident rates, and public safety reporting that earns regulatory trust. Core auto stabilizing. If the legacy car business stops deteriorating, it buys time and cash flow for the autonomy push. Stabilization means deliveries, margins, and inventory look less choppy. If that holds, the market can pay for the autonomy option with less fear of balance sheet strain. Watch for gross margins, X credits, inventory turns, and pricing discipline, even as autonomy ramps. Politics, brand, and regulation. He acknowledges brand damage in Europe and estimates a 5-7% permanent hit in the US, but argues autonomy will overshadow it. He also suggests a Trump administration could accelerate a federal roadmap favorable to autonomy. My take, regulation is the wild card. Federal posture can help, but a lot of autonomy policy is de facto local. State DOTs, city councils, and public sentiment after any high-profile incidents. Europe is its own regulatory universe. So I'd treat any national-level green light as necessary but not sufficient. Watch for city approvals, data sharing agreements, insurance frameworks, and how quickly approvals follow any safety events. Now, where do I agree with Ives? The physical AI framing is useful. If you believe robots that move through the world safely at scale are the next platform, Tesla is positioned uniquely because it closes the loop. Massive fleet data, rapid model iteration, immediate deployment on a standardized hardware base. That's powerful. The market still discounts a full autonomy business model. Investors are waiting for proof. Not demos, not restricted pilots, but durable, paid, multi-city operations with clean safety stats. When that hits critical mass, multiple expansion can happen fast. Leadership and focus matter right now. The companies that execute will widen the gap on data, partnerships, and regulatory trust. Where am I cautious? Timelines. 3 to 6 months to meaningful multi-city impact is extremely ambitious in the real world. I want to see paid driverless miles and third-party audited safety data accumulate, not just announcements. Market share concentration. 80% sounds like a best case in a fluid, politically sensitive market that cities may deliberately fragment to avoid reliance on one vendor. Demand versus narrative. If core auto doesn't stabilize, or if autonomy monetization lags, the stock becomes hostage to timelines again. What should we, as investors, actually track next? Concrete autonomy. KPIs reported consistently. Paid driverless miles, incident rates, disengagements, interventions, and rider NPS by city. Regulatory milestones, city and state approvals, operating domains expanding from limited daytime/clear weather zones to broader conditions. Monetization signals, pricing per ride, take rate, utilization, rides per vehicle per day, and contribution margins. Core auto health, gross margin trajectory, X credits, pricing stability, inventory, and whether software/FS*D-like features lift ARPU. Capital allocation, details following that shareholder meeting, how much CAPEX, OPEX is earmarked for autonomy and robotics, and the expected payback cadence. So, stepping back, Dan Ives is planting a very bullish flag. He's telling you to stop modeling Tesla as just a car company and start modeling it as an autonomy plus robotics platform, riding the physical AI wave, possibly the biggest profit pool of the next decade. If he's right about the pace and the breadth of rollout, the stock will need to be re-rated. If the rollout is slower, the story can still work, but the path to his $600 and multi-trillion scenarios stretches out, and the market won't give full credit until the cash flows show up. My bottom line, treat the next 6-12 months as the proof window. Celebrate announcements, sure, but anchor your conviction on operational evidence, real cities, real riders, real revenue, real safety metrics. If those stack up, Ives's call looks prescient. If they don't, it becomes another almost there year. Either way, we'll keep tracking the numbers, and I'll be back here to break them down with you as they land. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now it's to dive into the 3 best autonomous driving stocks to buy right now. Let's start with Baidu, ticker BIDU, China's answer to Google, but with a twist that most investors miss. While many see Baidu as just a search engine giant, the company has quietly transformed itself into a powerhouse of artificial intelligence and autonomous technology, setting the stage for a revolution in how people move around cities. Baidu's Apollo unit is running the world's largest fully autonomous ride-hailing service, Apollo Go, in major Chinese cities. This isn't just a pilot program or a handful of test vehicles. Apollo Go is a full-scale operation, with fleets of Robotaxis navigating the bustling streets of places like Wuhan, Beijing, and Shenzhen. They've already completed over 5 million real-world rides, no safety driver, just AI. Passengers hop in, input their destination, and the car does the rest, all without a human behind the wheel. This level of real-world deployment is unmatched by any other company globally. Every ride feeds data back into their system, making their AI smarter and safer, a flywheel effect that's tough for competitors to match. The more rides they complete, the more nuanced and robust their algorithms become, creating a self-reinforcing cycle of improvement that widens the gap between Baidu and its rivals. While others are stuck in testing, Baidu is scaling a real revenue-generating business. They're not just running demos for the press, they're serving paying customers every day, building brand loyalty and trust in the process. The Chinese government's support gives Baidu a regulatory tailwind, letting them expand faster than Western rivals. In a country where policy can make or break a tech initiative, Baidu's close alignment with government priorities is a massive advantage, smoothing the path for new launches and city expansions. Baidu's profitable core business funds Apollo's R&D, so they're not burning cash like most AV startups. This financial stability means Apollo can invest aggressively in technology, talent, and infrastructure without constantly worrying about raising new capital or cutting corners. The market still values Baidu as a search company, but you're essentially getting their world-leading autonomous division for free. Investors focused on search are missing the hidden value of Apollo, which could one day eclipse the core business in both scale and impact. Apollo's tech isn't just for Robotaxis, they're licensing it to automakers and helping cities manage traffic, building a mobility ecosystem. Baidu is positioning itself as the backbone of smart transportation, integrating its AI into everything from private vehicles to public transit and city infrastructure. Of course, there are risks, geopolitical tensions and Chinese regulations, but much of that is already priced in. The company has weathered regulatory storms before, and its deep government ties provide a level of insulation that most foreign competitors can only dream of. Compared to cash-burning AV startups, Baidu stands out, profitable, proven, and scaling fast. While others are still chasing their first dollar of revenue, Baidu is already building a business with real customers and real cash flow. Their full-stack approach, software mapping, cloud, even vehicle design, gives them control and integration others can't match. This vertical integration means Baidu can innovate faster, respond to challenges more nimbly, and capture more value across the entire autonomous vehicle chain. Baidu's talent pool is world-class, and their relentless execution is setting the pace for the industry. Their engineers and scientists are pushing the boundaries of what's possible in AI, robotics, and cloud computing, making Baidu a magnet for top tech talent in China and beyond. As Apollo Go expands, its value will become impossible for Wall Street to ignore. Each new city launch, each milestone in ride volume brings Baidu closer to global recognition as a leader in autonomous mobility. The total addressable market for transportation is in the trillions, and Baidu is aiming for a leadership position in the world's largest auto market. China's urbanization and appetite for innovation make it the perfect proving ground for autonomous vehicles at scale. Their technology, data, and government support create a moat that's hard to breach. Competitors face not just technical hurdles but also regulatory and cultural barriers that Baidu has already overcome. For investors, Baidu offers a rare combo, a stable core business and a call option on the autonomous revolution. It's like owning a blue-chip tech stock with a built-in ticket to the next big wave in mobility. Don't let the Chinese search engine label fool you. Dig deeper and you'll find a global AV leader. Baidu's reach is expanding beyond China, with partnerships and pilot programs in other countries, hinting at even bigger ambitions. The transition to autonomy will take years, but Baidu is already cashing in. Every ride, every partnership, and every new city adds to their lead, turning futuristic dreams into present-day profits. If you want exposure to the future of transportation, Baidu deserves a spot on your watch list. The company is uniquely positioned to benefit from both the rise of AI and the transformation of urban mobility. Their progress is relentless. More cities, more rides, more advanced tech every quarter. Baidu's pace of innovation and expansion is setting new benchmarks for the entire industry. This isn't a get-rich-quick play, it's a long-term bet on a fundamental shift in mobility. The real payoff will come as autonomous vehicles become mainstream, and Baidu is already years ahead of the curve. Baidu's undervalued AV business could be the hidden gem in your portfolio. As the world wakes up to the scale of their achievement, the upside potential could be enormous. Baidu's headline metrics look solid. Roughly a $47.66 billion market cap, earnings per share at $9.85, a P/E around 12.19, 2024 revenue reported at $133.13 billion, and net income at $23.76 billion. The story beneath those numbers is a pivot. Baidu's AI cloud unit is growing fast. Revenue's up about 27% year over year, powered by new models and partnerships including the rollout of ERNIE X1. That's important because it shifts the company's center of gravity away from a pure ad-driven model toward AI-led growth with more durable economics. Analysts have started to warm up to that thesis, and we've seen the stock catch a bid alongside broader Chinese tech optimism, but it's not clean. Operating income has reportedly fallen about 45%, and cash flow has turned negative, which raises sustainability questions just as the company leans into AI capex and model training costs. The stock has also been choppy. Earlier in September it spiked more than 12% on AI excitement and then gave back a chunk, so sentiment is fragile. My read: Baidu has a credible AI engine and real enterprise traction, but the next leg up requires stabilizing operating income and turning cash flow back to positive while the AI cloud mix keeps rising. For those willing to stomach some risk, the upside is hard to ignore. Baidu offers a rare blend of stability, innovation, and explosive growth potential, qualities that are hard to find in a single stock. Baidu is my first pick for the autonomous future. Their combination of technology, execution, and market opportunity puts them in a league of their own. Keep your eyes on Apollo Go, it's just getting started. The journey to full autonomy is a marathon, not a sprint, and Baidu is leading the pack. Next up, let's talk about a company you already know but probably underestimate. Our second pick is Uber Technologies, ticker UBER, yes, the ride-hailing giant, but there's more to the story than just hailing a ride with your phone. Uber has evolved far beyond its original business model, and its next chapter could be even more transformative. Uber's real endgame? Replacing human drivers with autonomous vehicles, slashing costs and boosting profits. Imagine a world where your Uber arrives with no one behind the wheel, just a seamless, efficient, and cost-effective ride, available 24/7. Instead of building its own AV tech, Uber made a bold pivot. It sold its self-driving unit to Aurora, took an equity stake, and partnered for future integration. This move allowed Uber to offload the massive R&D costs and risks, while still keeping a foot in the door of the autonomous future. Uber's strategy is to be the essential platform for all autonomous vehicles, not just one brand. Think of it as the app store for AVs. No matter which company builds the best self-driving car, Uber wants to be the place where riders connect with them. They've partnered with Waymo, Motional, and others, so no matter who wins the AV race, Uber wins by being the network. This multi-partner approach means Uber isn't tied to the fate of any single technology or company. Their global brand, massive user base, and sophisticated demand-matching tech are nearly impossible to replicate. Uber's reach spans hundreds of cities and millions of users, giving it a scale advantage that new entrants can only dream of. As AVs roll out, Uber takes a cut of every ride, without the risk and expense of building the tech themselves. This asset-light approach lets Uber focus on what it does best, connecting riders and vehicles, and optimizing the network. This platform approach de-risks the investment. You're betting on the racetrack, not a single horse. If one AV company stumbles, Uber still benefits from the others, making it a resilient play on the entire sector. Autonomy will also transform Uber Eats. Think food delivered by robots or self-driving cars, lowering costs and expanding reach. Imagine a future where your late-night snack arrives at your door, delivered by a robot, with no human involved. Uber's network effect is powerful. More riders attract more AVs, which lowers prices and wait times, attracting even more riders. This virtuous cycle strengthens Uber's position as the go-to platform for urban mobility. Financially, Uber is now profitable and generating cash flow, with AV integration set to supercharge margins. As the cost of rides drops and efficiency rises, Uber's bottom line could see a dramatic boost. The market still values Uber for its current business, but the autonomous angle could be a game-changer. Investors may be underestimating just how much upside autonomy could unlock for Uber's future. Uber's decade of urban travel data gives it a huge edge in optimizing AV deployment. This treasure trove of data helps Uber predict demand, plan routes, and maximize efficiency in ways competitors can't match. Their app is becoming the operating system for urban mobility. Rides, bikes, scooters, public transit, and soon, AVs. Uber aims to be the one-stop shop for getting around the city no matter how you want to travel. By taking equity in AV partners, Uber gets upside without the capital risk. If any of these AV companies become the next big thing, Uber shares in their success. Their global reach means they're ready to deploy AVs anywhere as soon as the tech is ready. Whether it's New York, London, or Tokyo, Uber can flip the switch and scale up instantly. Uber is a platform play on the entire autonomous revolution. It's not just about cars, it's about transforming how people and goods move in cities everywhere. Uber has a $209.16 billion market cap, EPS at $6.01, a PE near 16.64, 2024 revenue of $43.98 billion, and net income of $9.86 billion. The core thesis is durable, compounding growth across mobility and delivery, with a lot of attention now on the expanding commerce layer. Gross bookings continue to trend higher, and management points to an annual run rate that could reach about $12.5 billion in grocery and retail delivery by year-end. Partnerships matter here. Deals with ALDI and Citarella deepen the grocery marketplace and widen frequency. The market has noticed. Shares recently hit a 52-week high and we've seen price target bumps. Piper Sandler at $103 and RBC at $100. Strategy-wise, Uber keeps testing new edges, drone delivery pilots and targeted discounts on fresh groceries to drive convenience and retention while pushing toward higher-margin non-restaurant categories. The caveats. Insider selling, including by CEO 𝗗𝗟𝗧 triggered a roughly 4.9% pullback and reminded everyone that expectations are elevated with the stock near $99. At these levels, a lot of good news is already priced in. For the next move higher, Uber has to keep proving margin expansion in delivery, hold take rates, and offset rising operating costs. My checklist is simple. Watch contribution margins, frequency per user, and the cadence of new partnerships that actually add scale, not just headlines. If you want exposure to AVs without betting on a single tech, Uber is your pick. It's a diversified, scalable, and forward-thinking way to invest in the future of transportation. The future of ride-hailing is autonomous, and Uber is positioned to dominate. As the world shifts to self-driving vehicles, Uber's platform will only become more valuable. Don't underestimate this pivot. It could redefine the company. Uber's willingness to adapt and partner may be its greatest strength in the coming decade. Next, let's take the autonomous revolution to the skies. The future of mobility isn't just on the ground. Exciting new frontiers are opening up above us. Meet the flying taxi pioneer. For our final pick, we're leaving the roads behind and looking up. Welcome to Archer Aviation, ticker ACHR, a true pioneer in the race to make urban air mobility a reality. Imagine a world where your daily commute isn't stuck in gridlock, but instead you're soaring above the city in a sleek, electric aircraft. That's the vision Archer is bringing to life, and it's closer than you might think. Archer is building electric vertical takeoff and landing aircraft. Think quiet, efficient flying taxis for city commutes. These aren't just futuristic concepts, they're real machines designed to take off and land vertically from rooftops or small landing pads, making them perfect for crowded urban environments where space is at a premium. Their flagship, the Midnight, is designed to carry a pilot and 4 passengers, flying over traffic in minutes. With a range tailored for short urban hops, about 20 to 50 miles per trip, Midnight can turn a 60-minute drive into a 10-minute flight, all while producing 0 emissions at the point of use. Archer's focus is on safety, low noise, and efficiency, making air taxis practical for dense cities. The aircraft's electric motors are far quieter than helicopters, and its design minimizes noise pollution, so it can operate without disturbing city life below. Safety is paramount, with multiple redundant systems and rigorous testing protocols. They've built and flown full-scale prototypes and are in the final stages of FAA certification, aiming for commercial launch as early as 2025. This is a huge milestone. Getting certified by the FAA is a rigorous multi-year process, and Archer is one of the few companies in the world this close to the finish line. Major partnerships validate their vision. United Airlines has invested and ordered up to 200 aircraft, planning airport shuttle services. This isn't just a handshake deal. United is actively working with Archer to integrate these flying taxis into their operations, starting with routes that connect city centers to major airports. Stellantis, the auto giant behind brands like Jeep and Chrysler, is helping Archer scale up manufacturing in Georgia, solving the production challenge most startups face. With Stellantis' expertise in mass production and supply chain management, Archer is positioned to build these aircraft at scale, not just as prototypes. Archer plans to operate its own air taxi network, controlling the aircraft, booking software, and vertiports. This end-to-end approach means they're not just building the vehicles, they're creating the infrastructure and digital platforms needed for a seamless passenger experience, from booking your flight to boarding at a dedicated vertiport. The initial focus is connecting city centers to airports, where time savings are most valuable. These routes are often plagued by traffic jams and unpredictable delays, so a reliable, fast air taxi service could be a game-changer for business travelers and tourists alike. The urban air mobility market could be worth hundreds of billions. If Archer becomes a leader, the upside is massive. Analysts predict that by 2040, millions of people could be using air taxis daily, transforming how cities function and how people move. Risks are high. Archer is pre-revenue, and success depends on certification, manufacturing, and public acceptance. There are regulatory hurdles, technical challenges, and the need to convince the public that flying taxis are safe, affordable, and convenient. But they're de-risking fast: strong partners, clear milestones, and a credible path to commercialization. Every partnership and successful test flight brings them closer to turning this vision into a profitable business. The long-term vision is full autonomy. Initial flights will have pilots, but the aircraft is designed for future pilotless operation, slashing costs and boosting capacity. Imagine a city where fleets of autonomous air taxis operate around the clock, making urban flight as routine as hailing a rideshare today. Imagine commuting, attending events, or connecting cities, all by air cleanly and quietly. No more sitting in traffic or missing flights because of road delays. The convenience and time savings could fundamentally change how we live and work in cities. Archer's team includes veterans from Airbus, Boeing, and Google, and their partners bring manufacturing and operational muscle. This blend of aviation expertise and tech innovation is what sets Archer apart from the competition. The stock is volatile, but the potential is like investing in the first airlines or car companies. Early investors in those industries saw fortunes made and lost before the winners emerged. If Archer hits its milestones, early investors could see life-changing returns. The upside is enormous, but so is the risk. This is not a stock for the faint of heart. This is a moonshot, high risk, but potentially industry-defining reward. If Archer succeeds, it could reshape transportation as profoundly as the jet engine or the automobile. For those with a high-risk tolerance, Archer is a pure play on the future of urban mobility. It's a bet on a world where the sky is no longer the limit, but the new highway. The next 12-18 months are critical as they approach FAA certification. News here could move the stock fast. Any major update, positive or negative, could send shares soaring or tumbling overnight. Archer is building something entirely new, with the backing of industry giants. Their progress is being watched closely by both Wall Street and Main Street. Archer Aviation has a market cap of $5.37 billion. There's no recognized revenue in 2024, and a net loss around $536.8 million, so you're buying milestones and regulatory progress, not cash flows, yet. On milestones, Archer's Midnight eVTOL hit 7,000 feet in a test flight as part of its envelope expansion program. That is a meaningful data point because it speaks to performance ceilings and the path toward certification. The company is also slated to participate in the White House's eVTOL integration pilot program, coordinating with major U.S. airlines and key cities to accelerate real-world electric air taxi operations. That kind of public sector alignment can shorten the distance between flight tests and commercial use cases. But the market remains skeptical for good reasons. Certification timelines slip, unit economics are unproven at scale, and the company is burning cash while the funding window for pre-revenue stories has gotten tighter. For Archer, what matters next is flight test cadence, certification milestones, and credible commercialization partnerships that include deployment timelines and off-take commitments. If you want a shot at the next transportation revolution, keep Archer on your radar. This is a rare opportunity to invest at the ground floor of a potentially world-changing industry. It's a bold bet, but the payoff could be enormous. The winners in this space could define the next century of mobility. The autonomous revolution isn't just on the ground, it's taking flight. The convergence of electric propulsion, autonomy, and urbanization is opening up possibilities we've only dreamed of. For investors, this is a chance to get in early on a new era of mobility. The next few years will separate the visionaries from the rest. Archer is the high-risk, high-reward pick of the group. It's not for everyone, but for those willing to take the leap, the sky's the limit. Now let's wrap up with your next move. Consider your risk tolerance, do your research, and decide if you want to be part of this bold new chapter in transportation. Here's how to position yourself for the autonomous future. Whether you invest or simply watch from the sidelines, the age of flying taxis is coming, and Archer is leading the way. There you have it. Baidu, Uber, and Archer. 3 unique ways to invest in the autonomous revolution. Each has its own risk and reward profile, so consider how they fit your strategy. The future of transportation is being built now. These companies are leading the charge. Want to level up your investing? Check out my Value Stocks Investing Master Course. Link in the description. For exclusive tips and deep dives, join the Stocks Galore Patreon community. Which of these companies excites you most? Or is there another AV stock on your radar? Let me know in the comments. Don't forget to like, share, and subscribe for more investing updates. Thanks for watching, and I'll see you in the next one. The autonomous future is here. Are you ready to invest in it? Let's build your portfolio for tomorrow, today.